Leopold Aschenbrenner was a 25-year-old former OpenAI researcher when he published a manifesto that laid out the exact trajectory of the artificial intelligence boom. His 165-page paper, titled Situational Awareness, mapped out a timeline for artificial general intelligence. He warned Silicon Valley elites and national security officials that the real bottleneck wouldn't be software, but the physical constraints of the real world. Massive power grids and trillion-dollar server clusters. He could have used this acclaim to launch a think tank or a venture capital firm. Instead, in late 2024, he launched a hedge fund named after his paper to trade the most liquid markets in the world. He took his macroeconomic thesis and turned it into a balance sheet, putting billions of dollars on the line to prove his timeline was right. This chart tracks the fund's assets. Starting around $255 million, it rockets to over $20 billion by mid-2026. By June, it was up 439%. The inexperienced Aschenbrenner was suddenly compared to Wall Street veterans. Then, the morning of July 30th arrived. In a single stroke, the fund's entire public stock portfolio was liquidated in a desperate fire sale. The sole buyer positioned to absorb a distressed book of that massive size in one block was the multi-strategy firm Citadel, run by Ken Griffin. How does an investor map out the exact technological trajectory of the next 10 years, only to watch his fund collapse over the span of a few days? The core of the trade was a picks and shovel strategy. The fund went heavily long, meaning they bought stock in the physical building blocks of AI. That meant memory chips, specialized cloud data centers, and power companies. To balance the risk, they built a massive short position on the other side. They placed over $8 billion in put options, betting against software firms and certain semiconductor indexes that Aschenbrenner calculated were overvalued compared to the physical infrastructure. To amplify their returns, the fund used financial leverage, borrowing capital from prime brokers. They multiplied their market exposure up to 4 times what their actual cash on hand could support. Borrowing money to magnify a highly concentrated two-sided strategy creates immense stress. A minor fluctuation in stock prices forces the borrower to quickly come up with cash. This structure generates massive wealth when the longs go up and the shorts go down. But if both sides move in the wrong direction at the exact same time, the math turns hostile. That hostile scenario hit in July 2026. Meta announced a plan to sell excess cloud capacity, undercutting the scarcity of his cloud investments. Concurrently, a brutal sell-off in Asian markets crushed his memory chip holdings. At the exact same time, the software stocks he had shorted proved unexpectedly resilient, and their share prices began to rally. Because the fund was losing money on both sides of a leveraged book, their prime brokers at Goldman Sachs and JP Chase issued a margin call. They demanded immediate cash to cover the rapidly expanding losses. The timing created a stark historical artifact. On July 24th, Aschenbrenner sent an investor letter acknowledging the dip, adding a postscript noting it was a particularly good time to add funds. Days later, the prime brokers forced his hand. To avoid dumping billions of dollars into the open market and crushing the stock prices further, the brokers quietly negotiated a wholesale fire sale transfer of the entire public portfolio to Citadel. A 1-month drawdown in a structural bull market is normally a temporary setback. Leverage converts that temporary volatility into permanent execution. Situational Awareness LP technically survives today, but only as a shell of its former self. It operates strictly as a holding company for private market investments. Its dominant remaining asset is a massive early stake in the AI startup Anthropic, which represents roughly a fifth of the fund's original assets and is highly illiquid. While the Anthropic shares retain tremendous paper value, the billions of dollars in liquid public stocks, the core engine of the firm's explosive ascent, are entirely gone. The fund is now anchored to a single private asset, stripped of the capital and trading leverage needed to actively maneuver around Aschenbrenner's ongoing research. Looking closely at the underlying thesis, Aschenbrenner was right. NVIDIA eventually cleared a $4 trillion valuation, hyperscaler infrastructure spending surged exactly as he modeled, and power grids became the ultimate constraint. He accurately diagnosed the macro trajectory of global technology over a multi-year horizon, but his portfolio could not survive the micro-volatility of a single summer month. In financial markets, absolute intellectual conviction paired with heavy leverage leaves no room for error. When the path to the future isn't a perfectly straight line, that exact combination will be what breaks you.